So one of the first things I think about from a terminology perspective is the profile of the owner. I came from an institutional real estate background. I worked for a company called Invesco Real Estate, and institutions typically represent endowments, foundations, and public pension funds. So when you hear the term institutional real estate, that typically means high quality real estate assets in high quality markets that are owned by large endowments, foundations, and public pension funds. When I think about key terminology within commercial real estate, I also think about strategy in terms that suggest strategy differences. So when we think about the strategy of investing in real estate, there's something known as a core strategy, a value add strategy, an opportunistic strategy. And all that represents is the varying elements of risk associated with that strategy. So let's sort of take them in turn. If we talk about a core strategy, if somebody is a core investor today, that means they're a very low risk investor and they're getting very low returns as a result. They typically are investing in the primary markets, meaning the 6 what we call the gateway real estate markets, which is Boston, New York, Washington, D.C., Chicago, L.A., San Francisco. So core investors tend to stay in what we call the gateway real estate markets. And the reason they prefer to stay in those markets are those are the most vibrant economies within the United States. So those are the largest cities and consequently the most vibrant economies. And when you think about real estate investing, you want to be investing in vibrant economies because you are looking for job growth. At the end of the day, one of the key aspects of investing in real estate is there job growth in that market? Because if there's job growth in the market, people are going to need apartments. If there's job growth in the market, people are going to need office space. If there's job growth in the market, people are going to do more shopping. If there's job growth in the market, there's going to be more online shopping, and you're going to have need for industrial asset space from the standpoint of the Amazons of the world. So when we think about core investing, it's investing in the highest quality markets, in the highest quality product, meaning new product, with the highest quality tenants. Those 3 elements would suggest a lower risk profile from an investment perspective. Now, as we go up the risk curve, the next strategy is called value add. And value add investing is basically buying assets that have some aspect of the profile that is broken, that needs to be fixed. A perfect example of value add investing would be the acquisition of Class B and C apartment assets. And this strategy has been done extensively over the last 8 to 10 years. The strategy really involves buying these assets that are in need of improvement. And the improvement typically comes in the way of updating the kitchens to include things like stainless steel appliances, granite countertops, new cabinetry, new flooring, and to upgrade the bathrooms for lighting and the fixtures and so forth. So you buy the Class B and C office building, you upgrade the kitchens and the bathrooms, and hopefully you can move a C apartment to a B apartment, or a B apartment to a B plus apartment, and you're able to charge higher rent. So the value add strategy is I'm buying it broken, I'm fixing the kitchens and bathrooms, I am then able to lease it to tenants who are going to pay me more in rent. The final strategy of the 3 primary strategies is what we call opportunistic. And that's really nothing more than development. That's the highest risk profile that there is, because if you think about the real estate development industry, that means you are building buildings. So that means you really are just starting with land. You have no building, you have no tenants. Think about that relative to core, where you have a building, a very high quality building, you have high quality tenants. So it's the entire opposite of that spectrum. So within the investor universe, you typically find core investors, value add investors, and opportunistic investors. A couple other key pieces of terminology that I want to talk about relate to the return profile of an investment and the return metrics of an investment. The first metric I want to talk about is something called an income yield. The income yield is also known as a cap rate, or the capitalization rate for an asset. The income yield is the net operating income of the property divided by what your acquisition basis is in the property. And when we say basis, if we're buying it for $5 million, our basis in the property is $5 million. If you buy it for $5 million and immediately invest another $1 million into the property in the way of the kitchens and the bathrooms, your basis is now $6 million. So the income yield is the net operating income of the property divided by the basis. It's also known as the cap rate. The cash yield of the property is the property before tax cash flow divided by the same basis. And the relationship between the income yield and the cash yield is reflective of the capital expenditures and the leasing costs that will be incurred at the property. The final metric that we want to talk about is the internal rate of return. The internal rate of return is effectively the interest rate, the rate of return, the total return that investors earn on the property. The total return is found by aggregating and projecting the operating cash flow plus the residual. And we bring those cash flows back to the present value at whatever the required return that we seek to earn on the property. So if we need to earn an 8% internal rate of return on the property, we discount the residual value and the operating cash flows back to a present value metric using an 8% return.